Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today, we're going to take a look at some cannabis stock gainers and losers. Going to talk about a dead cat bounce, which is a false recovery in the market, and how cannabis is moving inversely from the overall market, doing a lot better than the S&P. Some of the gainers from last week, been Aurora, Tilray up double digits at 15%. Cureleaf and Organogram up 8 and 7% respectively. Hexo up 5%. Some of the losses being Kushco, Green Lane. I know Kushco had to lay off some people, so their shares are down 25%. Looks like some of the investors might be concerned about their ability to continue on. Cannabis stocks were heavily hit already before the coronavirus, and then everything, including gold and cannabis, and everything got hammered. A lot of margin calls have been met. A lot of the initial phase of that selling out has subsided. But for people who think there's going to be an early recovery or fast recovery, like a V shape, goes down and comes right back, I think we are in this for the long haul. I think there's going to be a lot of volatility, so opportunities to make money as you see some of these stocks bounce, especially the penny stocks. You're going to see 20-30% every other day potentially as volatility continues to move on. Right now, we have a fear-based market where there isn't any really underlying economic issues yet. Obviously, people have had to go home. There's a lack of production. A lot of that is baked in. But when the ultimate supply constraints occur and the automotive and the airline industry run out of cash and they don't have employees and all of those things become systemic, that's when the next wave will happen. So I think there's going to be another huge bailout with helicopter money for, student loans and auto and airline and hotels and you name it. But the general public will get that for, like I said, the student loan bailout and a housing bailout. Real estate investment trust for commercial side is already lobbying to get some money. They need some bailouts as no one's paying rent. That'll happen in the regular retail market. So residential mortgages and those real estate investment trusts or REITs will also take a hit. Housing, I would expect to drop, worst case scenario, 85% in certain areas in North America for housing to drop as the paper markets push that down, as individuals who bought houses with cash as a foreign currency play. And I'm primarily talking about the Chinese going to Toronto and San Francisco and Seattle and Vancouver and buying up real estate with cash as the Chinese yuan was decreasing in value. Chinese were buying houses like a safe. So if they feel the Chinese yuan is at its low, or if the Chinese implement a gold-backed currency, you may see a mass exodus out of housing back into the local currency as it rises, because there's going to be they already have their oil platform that could be also backed by partially with gold. So there's going to be a lot of changes. And so I would really try to take a look at precious metals as gold and silver are out there. Silver is the cheapest it's been relative to gold prices in about 5,000 years. So that silver to gold ratio is incredibly affordable, should I say, or enticing to a lot of people looking at how silver may increase dramatically. But as sin stocks are out there now, cannabis is involved. So before it was defensive stocks, like Boeing, as well as tobacco and alcohol. Now we have cannabis for the first time. So I would be cautious of investing long term, but I would look at possibly trading if you feel like you can time the markets. We did a podcast a while back called Hedging Your Bets with Sin Stocks. Did that 10 months ago. And so it's kind of good timing, I guess, almost a year in advance. So they do better because people want to go towards cannabis. We saw in France them outlawing alcohol entirely. And so there could be a whole new wave of people who try CBD and THC products that never tried it before because there's delivery. They've been deemed essential businesses by 6 different states. and now they're publicly traded. So not only can you invest because your pension is being annihilated, um, mind you, pensions need 7% just to break even. So with a GDP potential being negative 15% in the US, that's a 21% difference. If you're not, making anything in the US and you don't have people contributing, then either you need to reduce the amount of benefits that pension holder gets, or you need to increase taxes. So it's not good for anybody involved, especially Illinois. As people leave that state, they're not adding or contributing to that fund. So whether it's California, CalPERS, or Illinois, I think that a new financial monetary system is probably going to occur. I don't know if it's going to be a standard drawing right, an SDR, or partially backed, gold note. But I do know that with the amount of printing they're doing with this quantitative easing, QE to infinity, it's not building confidence. And with fiat currency, that currency is only backed by the full faith and credit of the US government. And there is no faith, and credit is debt. So we are already seeing countries selling their treasury notes, bills, and bonds, getting out of it entirely, repatriating their gold, which is a lack of trust when it used to be held in Fort Knox or New York. They're just saying, nope, we want it back. So a huge change around the world for sure. One way to gamble, since Vegas is closed, throw some into cannabis stocks in a portfolio or index. Not all are created equal. And I will tell you that this is just the beginning of a potential storm. In my humble opinion, this is not going to be a V-shaped recovery. A lot of the bulls want that to be the case. They want this to not be a dead cat bounce. They're trying to revive the cat, and just it's a reference to even a dead cat can bounce. And so when the market comes back up into a recovery, we even saw an 18% jump in the 1933 decline. So as it came all the way down, almost 30%, came back up 18%, and then dropped back down again. So maybe not the best of terms, but a dead cat bounce. This definitely is. We're going to see a lot of volatility. You're going to see some false breakouts, but it's not going to be a recovery. I think if you do see anything, it's going to be initially the bailed out companies and sin stocks. So Cannabis this is the first time that they're publicly traded. They weren't publicly traded 10 years ago in the last collapse. So we're going to start to see a lot of those companies succeed and probably use some of that money to gobble up other companies, make their balance sheets a little bit stronger. Cannabis indexes aren't anything new. You've heard of PODX or MJ, the ETF MG Alternative Harvest Index. This is our own individual index. We have 19 stocks, and there was a lot of activity last week. Kind of wanted to highlight that we got Tilray at 105% increase in 4 trading days. Again, that's because it's trading at $3.85 when we got it. It closed out at almost $8 last week. And so with some of these other ones like InBev and Hexo being penny stocks, it's easier for those percentages to jump up to 65% for Hexo, for example, in just 3 days. Our trading robot is able to figure out what is the optimized risk. And so it's not as risky as other funds are. And you can see that when we compare our last week's return with some of the investors or with some of the competitors. But before I show the competition, I'll show you that our year-to-date performance is 11.5%. Since its inception, we started this in August, we're up 42.7%. So comparing that to MJ at the beginning of August, they are negative 56%. PODX is negative 56%. We are positive 42%. Now, year to date, they made some serious gains last week. And so MJ is now down just 29%, and PODX is down only 34%, while we're positive 11.5%. So it's still almost a 50% difference between these two. But I wanted to point out that MJ and PODX made a substantial increase in just 1 week. So they're willing to take massive risks in order to get themselves out of this huge hole, whereas we don't have to do that. We could, but we aren't 2x 3x. We aren't highly leveraged, and we aren't highly risky. You can change those metrics, the Black-Scholes or the Sharpe ratio. You can take on additional risk, but we don't need to. As time moves on, we might lax those rules. But right now, I think it's showing that this index is working, that we have quarter-over-quarter increases, and that our AI-based algorithm with technical analysis and predictive analytics is doing really well. So I'm not saying you should time the market, but I am saying that with dollar cost averaging either up or down, you can put in a little bit every week, every month, whatever your timing or duration is. But I think now is a good time to get in as we're starting to see a separation from cannabis and the S&P. Cannabis stocks are definitely outperforming the S&P, and I think will continue to do so, except in waves of complete annihilation. And I think we're going to see more of those as time goes on and some of this news catches up. I always say the word hysteresis, which is the phenomenon in which the value of a physical property lags behind the changes affecting it. So all of this shutdown is here, but I don't believe that the drop in the stock price is fully reflected. And so we're waiting for the rest to catch up. What I mean by that is the supply chain disruption hasn't even happened yet. So when everything has to be shut down in China, that's like 3 months out for an airline company or an automotive company to get those parts. So right now is kind of that lag time between it being affected and the current stock price, which is based on fear and not really fundamentals. Once the fundamentals catch up, I think we're going to see another wave. I don't think that it's completely baked in. I don't think those numbers are fully reflecting the carnage that's going to happen. And even with the trillions of dollars in bailout, that's not all going to trickle through to the economy when there's going to be a massive amount, potentially 20% layoffs. So I do think that there's going to be an inverse relationship to the market. It's my opinion that cannabis stocks will have a higher return than other stocks. So you'll have to look at vice stocks, being tobacco, alcohol, cannabis, as well as defensive stocks, all working in tandem together inversely to the overall market. So I think you'll see a higher return with those than somewhere else. But ask your financial advisor, and then obviously diversify into a portfolio. Try to find something that works for you. But this is not financial advice. With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out.